Should I go with an FHA loan or a conventional loan? And I just want to go through some of the pros and cons of each of these. I like to go with conventional loans, but if you're unable to go with that, FHA can help get first-time home buyers into a house at the very least. With this, you need a minimum of 3.5% down. The negative that I see is they front-end load the 2.25% mortgage insurance premium. A lot of times this gets rolled into the cost of the loan over the life of the loan, and you can never get rid of the MIP. You tend to have higher interest rates for an FHA loan, and that's for good reason. Basically, you have a 50% debt to income ratio, which is very high. You have lower credit scores, so a bad history or no history of paying bills. And then it's a government loan. Now, with a conventional loan, positives seen here are a lot of sellers that when they're selling their house and they have to pick, and they look at a conventional loan and then they look at somebody that has an FHA loan, if they're worried of whether or not that person can actually make it to closing, they may see that the conventional loan, they may go with them over the FHA loan. They just tend to see them as being more trustworthy. So if you can go with conventional, especially when it's a seller's market, that can give you a little bit more of an edge when trying to bid on a house. So typically you'll see something in the 5 to 20% down payment. So it's not incredibly much higher than that, so 3.5% versus 5%. Your PMI tends to be a bit lower than this. I've seen it down to a less than 0.5% if you have good credit. So the PMI, they can remove that once you hit 78% of the loan to value ratio. Basically it becomes automatically removed. Or once you get down below 80% loan to value ratio, you can just write a letter, send an email, and then the loan company will just remove the PMI payments, which is kind of nice. So that gives you an incentive to pay down the first 20%. This has lower interest rates, and if you're above 740, it gives you some of the best interest rates. Once you get above 740, you might get a slight change to 760, but it's not much of a difference. So this, you don't want to go above 36% of your total debts to your income. This, you have to have a 620 credit score or above. Again, if you're at a 660 versus a 760, that could be a change of 1% in your interest rate. So you really want to work on your credit score, and I have a couple of tricks to actually boost your credit score without actually paying any money. Check your credit report, see if there's any errors or things you've paid off that you may have missed a payment. You can get rid of them and dramatically increase your credit score. The other one would be pay down credit cards to below 30% usage. That has a high impact as well. And then these are privately held. If you're looking to become financially educated, how to make more money, how to save money, how to reduce your tax liability, how to invest, please subscribe and have a great day.